South Africa's current account deficit remained unchanged at 6.4% of gross domestic product in the third quarter. However, lower than expected dividend payments to offshore investors counted a shortfall on the trade account, causing the current account to widen to 202.5 billion rand. Spending dropped 1.9% to 3% in the third quarter. That's due to a sharp slowdown in inventory accumulation, mainly driven by strike-hit mining companies. Well, let's delve into this right now. We've got Andrea Macias joining us from Morgan Stanley. Thank you so much for joining us today, Andrea. So your thoughts on firstly, let's start off with the SARB quarterly bulletin, because they talk about the impact of the strike action on the data and the fact that we saw growth in domestic expenditure slowing to an annualized 3%. What did that number say to you?
Well, as you mentioned, the actual deficit printed at 6.4, slightly lower than consensus expectations of 6.7. Mainly the upside coming through from higher exports. So I think a lot of people were expecting a huge knock to particularly platinum exports. That didn't necessarily come through. And what you did see actually was outside of coal exports, the numbers held up pretty well. On the inventory side, yes, you did have a much slower rate of inventory accumulation compared to historical trends. And so that would suggest that perhaps these mining companies were running down on the inventories.
What is concerning is that households in South Africa are spending less, and the rate of growth in consumption continues to slow down. It's at 2.6% in quarter three from a revised 3.1% in the previous quarter. What is your sense as to the health of the consumer right now and households in South Africa, which have been pretty much driving the recovery here?
Yeah, absolutely. I think households are, being squeezed from an inflation perspective. You are seeing much lower rates of disposable income growth, mainly coming through from slower wages. And then, of course, there is pressure on the employment situation as well. So confidence is being knocked. Employment situation, isn't fantastic. And, of course, you still have pretty high levels of debt. So you are seeing a continuous rate of deleveraging. Having said that, though, what you did see today was debt to disposable income was pretty sticky, unchanged around 7.6%. But underneath that number was a very slow rate of disposable income growth as well as debt growth. So the number was unchanged.
76%, whether it's 76%, 75.5%, it's still a very big number when it comes to that debt to disposable income level. What's a level we should be realistically aiming for?
Well, if you were to argue it from a developed market perspective, I'm sure a lot of the developing countries would be very happy with a 76% debt to disposable income number. In South Africa's case, we ramped up pretty aggressively in the 2002 to 2005 cycle. We have come off over the last couple of quarters, but I think it would certainly do the consumer well to sort of deleverage even further. In terms of a specific number, very difficult to say. It has a lot to do with the stage of the business cycle that you're in. So I wouldn't want to be pinpointed to an exact number, but further deleveraging wouldn't be such a bad thing.
Yeah, just before we move on to the current account figure, we saw a pickup in gross fixed capital formation, 7.2% rise there in quarter three. Were you encouraged by that number there?
Certainly, but let's just be cognizant of the fact that it was driven mainly by general government. So you had around 23% Q-on-Q annualized growth rate in that sector. Whether or not that's a good thing, I think certainly from a growth perspective, it's certainly supportive. But too much of government intervention and investment in the economy obviously does suggest some crowding out of the private sector. And that's exactly where the growth needs to come from. Private sector growth, very disappointing, just around 2% today. And that's really what this economy needs to really kickstart the recovery.
Let's talk about the rand and the current account deficit, 6.4% of GDP, and a currency trader saying the positive reaction we're seeing from the rand as a result of the fact that it wasn't 6.6%. But what's the outlook now for that current account?
Well, that's where we are probably a little bit more bearish in that sense. What you saw today was a significant amount of cash repatriation from local commercial banks. They repatriated around 20 billion rand worth of their FX deposits that were previously sitting in offshore accounts. They've subsequently brought those cash balances home. If you think about the momentum in equity inflows on the portfolio side, that's been negative, and we expect that to continue to be negative. Bond investments, we think that has been pretty strong, but going forward, that's likely to slow. So in terms of prospects for funding this current account deficit, there really doesn't seem to be that much good news. And so from a currency perspective, I would think that as time goes, I think the markets are going to start trying to push currency back up towards 9.
Well, thank you, sir.
Not a great story on the funding, unfortunately.
No, it isn't. And of course, that's what everyone is saying. We are going to see this weakening in the rand going into next year if something drastically doesn't change on the export or import front.